All right, let's get into it. Today, we're taking a guided tour through something that can feel, a little intimidating, a mutual fund report. We're going to break it all down, using the Parag Parikh Flexicap fund as our real-world example.
Have you ever had this happen? You open one of these reports, and you're just hit with this wall of numbers and charts and financial jargon, and your eyes just start to glaze over. It's so easy to just feel lost and give up. But what if you could actually understand it?
Well, that's exactly what we're about to do. We're going to take this one report and translate it piece by piece into plain English. By the time we're done here, you'll know exactly what to look for and what it all really means. Okay, let's dive into this. First things first, every single fund has a mission statement, right? It's called the investment objective. Think of it as the fund's promise to you, the investor. So what's this fund actually trying to do with your money? Okay, let's really break this down because pretty much every word in here matters. The first key phrase is long-term capital growth. What does that mean? It means this is about playing the long game, not making a quick buck. And the other big one? Actively managed. That tells you a real person, a fund manager, is at the wheel making decisions on what to buy and sell. And the name itself gives us a huge hint. Flexicap. That just means flexibility in, company size or market capitalization. So this fund isn't stuck investing in only giant corporations or only tiny startups. The manager has the freedom to go wherever they think the best opportunities are. Okay, so a mission statement is great and all, but did they actually deliver? Let's move on and see how the fund has really performed on its promise. This is where we get into the numbers. And wow, the numbers here tell a pretty clear story. Just look at this bar chart. It shows the fund's average return over 5 years, and you can see it right there. It's standing taller than its market benchmark, which is kind of like the market average, and it's also beating the average of other similar funds. That's a really strong sign.
But investing is never that simple, right? It's not just a smooth ride to the top. When you look at the year-by-year numbers, you see the real story. Look at 2021. What a huge year. But then, bam, 2022. The fund was actually down. And what's interesting is, the benchmark was up that year. Looking at it this way is so important because it shows you the real journey, the ups and the downs, not just some neat and tidy average.
Now, performance is really only half the story. We absolutely have to talk about risk. I like to think of it as the bumps in the road. It's not just about how fast you get to your destination, it's about how bumpy the ride was. For that, we've got a couple of key numbers to look at. First up is something called the Sharpe ratio. I love this metric. It's basically a bang for your buck score. It answers a simple question. For all the risk and volatility I had to put up with, how much return did I actually get? As a rule of thumb, a Sharpe ratio over 1 is considered good. Over 1.5 is excellent. So at 1.65, this fund has done a fantastic job of rewarding its investors for the risk they took. Next, we have beta. Think of it this way. If the whole market is a boat rocking on the waves, beta tells you how much this fund's boat is rocking in comparison. A beta of 1 means it rocks exactly like the market. This fund's beta is 0.57. So what does that actually mean? It suggests that if the market drops by, say, 10%, this fund might only drop by about 5.7%. It shows that it's been less volatile, fewer crazy swings than the market as a whole. So we know the mission, we know the performance, and we know the risk. But what are you actually buying when you put your money in here? Let's pop the hood and take a look inside the portfolio.
First, let's see how the money is split up. And right away, something kind of jumps out at me. Look at that, 22% held in cash. That's a pretty big chunk for an equity fund. Now, what could that mean? Well, it might suggest the fund manager is being cautious, maybe keeping some cash on the sidelines, waiting for the right moment to buy.
And here's something you don't always see. This fund has a bit of a global flavor. While most of its money is in India and Asia, it's got a solid 15% invested in the United States. That gives you a nice layer of diversification that you might not get from other funds. And here we go, the fund's biggest bets. These are the top 5 companies the fund has the most conviction in. You see a lot of well-known Indian financial and industrial giants in here, like HDFC Bank and ICICI Bank. This gives you a really tangible sense of the manager's investment style. So when we zoom out a bit, what does this all add up to? A couple of things. First, even though it owns 135 different stocks, it's pretty concentrated. Nearly half its money is in just the top 10 companies. Second, it's making a big bet on one specific area, financial services. The real question for you is, are you comfortable with that kind of focused approach? Okay, last but definitely not least, let's talk about the fees. This is the final and really important piece of the puzzle, because even the best performance in the world can get chipped away by high costs. So let's see what you're paying for.
This is called an exit load. Basically, it's a fee for selling your investment too early. The fund really wants you to think long-term. So if you sell in the first year, there's a 2% fee. Between 1 and 2 years, it drops to 1%. And if you hold on for more than 2 years, the fee is 0.
And finally, here it is, the expense ratio. This is the ongoing cost you pay every single year, like clockwork, just for owning the fund. It covers everything from the manager's salary to research costs. This number, 0.63%, is what you pay for that active management we talked about right at the beginning. It's so important to know because it directly eats into your returns over time.
And there you have it. We've gone from the big picture mission to performance and risk, all the way down to the nitty-gritty of the portfolio and the fees. You've now got the basic toolkit to look at the most important parts of any fund report, not just this one. So, the next time you open up one of these reports, you're not going to feel lost. You'll know what to look for, and you'll know what questions to ask. So I've got one last question for you. Armed with all this new knowledge, what's the very first thing you're going to check?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.